Hey everyone, and welcome to this Masterclass Explainer. You know that feeling when you pull up a trading chart and it just looks like a chaotic, jagged mess of spikes? It can be totally overwhelming. Well, if you've ever felt that way, you are in exactly the right place. Today, we're demystifying the most famous, yet honestly, the most heavily misunderstood indicator in the trading world, the moving average. I like to think of it as the ultimate pair of noise-canceling headphones for your charts. It tunes out all that random static so you can actually hear the true rhythm of the market. But that brings up a pretty massive question. If this tool is so incredible, why do roughly 90% of traders totally fail when they use the most famous moving average strategy in the world? We've all been there, right? Losing our hard-earned money to fake outs and false signals because we entered a trade blindly. Well, by the end of this explainer, we are going to expose exactly why those fake outs happen, and I'm going to hand you the professional, rules-based system to fix it for good. So, here's our game plan for transforming your charts today. We'll start by demystifying the moving average, then move on to identifying the market trend, mastering the crossover strategy, understanding dynamic support and resistance, combining indicators for Confluence, and finally, we'll wrap up with how to trust the process. All right, let's jump right into section 1, demystifying the moving average. Basically, a moving average is just a constantly updated average price over a specific time period. Think of it like a room full of 10 people. You want to find their average weight, so you add them all up and divide by 10. Simple, right? But if one person leaves and a new person walks in, that average immediately changes. That is exactly what this indicator does with price over time. By calculating this rolling average, the indicator looks right past those random, minute-by-minute price fluctuations to reveal what's actually going on, the true underlying momentum. Now, you're going to run into two main types out there, and there's a huge difference between them. The simple moving average, or SMA, gives equal weight to every single price point in your chosen period. Because it counts a price from 20 days ago exactly the same as it counts today's price, it lags just a bit. But the exponential moving average, the EMA, that's a different beast entirely. It heavily weights recent data. Because it prioritizes what literally just happened over what happened weeks ago, it reacts so much faster to quick price changes. Depending on your trading style, picking the right period is absolutely crucial. Professionals usually stick to a few standard lengths. Use the 10 to 20 period for short-term, fast-moving trends, which is perfect if you're scalping. Step out to the 50 period for mid-term significance. That's fantastic for swing trading or even traditional stock investing. And finally, the 200 period. That one is the undisputed king of long-term macro trends. Moving right along to section 2, identifying the market trends. You've probably heard the classic trading rule, the trend is your friend until it ends. Well, the moving average tells you exactly which friend you're hanging out with. If the current price is staying above the moving average line, you're in an uptrend. Simple as that. You should only be looking for buy or long positions. On the flip side, if the price falls below the moving average, the bears are in control. It's a downtrend and you're only looking for sell or short setups. But wait, let me ask you this. What if the price isn't clearly above or below? What if the candlesticks are just kind of weaving back and forth right through the line, completely chopping it up? Listen closely because this is a massive warning sign. That weaving action, it means you are in a sideways ranging market. This is literally the biggest trap for beginners. When the market is just chopping sideways, moving average strategies will throw off dozens of false signals. If you try to force trades here, you will absolutely wipe out your account. So when you see that line going flat and the price just weaving through it, your only job as a trader is to sit on your hands and wait for a clear trend. Okay, let's dive into section 3, mastering the crossover strategy. The very first pattern you've got to memorize is the golden cross. This happens when your fast line, let's say a 20-period EMA, crosses above a slower line, like the 50-period EMA. This crossover is a massive signal that short-term momentum is officially overtaking long-term momentum. It signals a bullish shift and tells you, hey, it's time to start looking for high-probability buy entries. Now, opposite of that, we have the intensely named death cross. This is exactly what it sounds like, the reverse. Your fast 20-period EMA crosses below your slow 50-period EMA. This immediately alerts you that the bottom might be falling out of the current trend, pointing to a bearish reversal. When you see a death cross, you need to shift your whole mindset and start hunting for sell positions. But hey, remember that 90% failure rate we talked about earlier? Yeah, that happens because amateurs jump in the absolute millisecond those lines cross. Here is the exact checklist the pros use. Step 1, sure, wait for the crossover. But step 2 is the game changer. Zoom out and check the history. Does this specific currency pair or stock actually respect crossovers in the past, or does it tend to fake out? If the history looks solid, move to step 3. Do not chase the price. Wait for it to pull back and actually retest the moving average. And finally, step 4. Only pull the trigger when you get a confirmation candlestick, like a massive bullish or bearish engulfing candle. That right there is how you get a sniper entry. Oh, and here's a massive pro tip for when it's time to actually get out of the trade. Beginners usually wait for the lines to cross back the other way before they take their profits. But remember, moving averages have a bit of lag. So, waiting for a reverse cross usually means giving back a huge chunk of your hard-earned pips. Instead, try using a volatility-based exit indicator, like an ATR trailing stop loss. It hugs the price much closer and really protects your wealth. Next up, Section 4, Dynamic Support and Resistance. So instead of just looking at these things as lines that cross each other, I want you to think of a moving average like a giant rubber band. When the price is trending beautifully, it'll push away, stretch that rubber band out, and then eventually snap back to the average. As it snaps back, the moving average acts as a dynamic support floor in an uptrend, basically bouncing the price higher. And in a downtrend, it acts as a dynamic resistance ceiling, swatting the price lower. You always want to buy at the floor and sell at the ceiling. All right, Section 5, Combining Indicators for Confluence. This is where the magic really happens. Just look at these numbers. This brilliantly shows the raw mathematical power of filtering your trades. Let's say you trade an indicator like the parabolic SAR entirely on its own. Historical data gives that a base win rate of roughly 38%. Not great, right? But if you simply add a 200 EMA to your chart and use it as a filter, that win rate jumps up to 46%. Look at the supertrend indicator. It jumps from 39% to 48%. Just by adding a single moving average, you're dramatically tilting the math in your favor. So how exactly are we getting that massive boost in our win rate? It's simple, by following one ironclad rule. The 200 EMA is your ultimate veto. Let's say your secondary indicator, whether that's the RSI, supertrend, MACD, whatever, flashes a buy signal, but the price is currently sitting below the 200 EMA. What do? You ignore the trade entirely. You only accept buy signals above the 200 EMA, and you only accept sell signals below the 200 EMA. No exceptions. Which brings us to our final part, Section 6, Trust the Process. Look, success in trading is almost never a straight line. It looks way more like an exponential curve. Right now, you might feel like you're in the flatline phase. You're putting in the work, you're learning these moving average strategies, but maybe you just aren't seeing massive profits yet. It is so incredibly easy to give up here. But mastering your emotions, managing your risk, and just surviving this flatline phase of practice, that's exactly what separates the pros from the amateurs. All the real wealth is waiting for you right after that curve shoots upward. So, I have a challenge for you. I challenge you to commit to this disciplined, rules-based system for 6 solid months. Seriously, don't just jump from strategy to strategy every single week. Stick to your EMAs. Wait for your crossovers, confirm your entries with candlesticks, and always honor that 200 EMA rule. 6 months of extreme focus will completely transform your charts, your account, and honestly, your life. Because at the end of the day, as this quote beautifully reminds us, you are just one trade away. You're just one disciplined trade away from proving to yourself that this actually works. So the question is, will you stay patient enough to survive that flatline phase? Or will you just become part of the 90% who fail? Go find your trend, trust the process, and happy trading.